Welcome back to the deep dive. And Merry Christmas to you if you're celebrating. I know the calendar says December 25th, but the market never really sleeps.
It definitely doesn't.
And today, we're sipping away from the holiday festivities to do a really forensic deep dive into one of the most complex and, frankly, painful stock corrections we've seen in AdTech. We're talking about the trade desk, ticker TTD.
For years, TTD was the poster child. I mean, it was the undisputed jewel of the crown in independent ad technology. It was seen as an essential asset for any, growth-focused portfolio.
All right, priced for perfection.
Literally. As if it was incapable of failure.
And that's exactly where the story gets so interesting. TTD has been hammered by this brutal, really prolonged correction from its peak, and it's lost so much of that premium. Now, the easy answer is to blame rising interest rates.
Of course.
But our sources show that just doesn't capture the whole picture. The macro environment, it feels like it just pulled the curtain back on some really deep structural issues.
Precisely. This isn't just simple multiple compression. The market has performed what I call a rational reevaluation.
Yeah.
Our mission today is to really dissect the four critical pillars of this deterioration, structural, competitive, and fundamental, that have just permanently changed the risk-reward equation for TTD.
Okay, let's lay them out for everyone. So we're going to unpack this quartet of problems. First, there's the loss of investor trust after a really critical execution failure.
Oh, baby boy.
Second, the fundamental and I think often overlooked issue of questionable earnings quality. And that's all tied to internal compensation.
Mm-hmm.
Third, some internal friction around their key product platform, Kokai. And finally, the big one, the existential competitive siege from the walled gardens with Amazon really leading that charge.
So if you're looking at TTD, whether you hold it or you're thinking of buying the dip, these four factors really explain why it's just not the flawless growth stock the market once thought it was.
Let's start right there with that historical status. For years, TTD traded with a valuation that demanded, perpetual 30 to 40% growth.
And zero mistakes. The margin for error was non-existent. We saw PE multiples pushing past 100x sometimes.
When you're priced for that kind of perfection, any little crack is going to cause a massive problem.
And that belief system completely fractured in late 2024. The point of inflection, the moment it all changed, was the Q4 2024 earnings miss. And you have to think about the history here.
Right.
TTD had an immaculate record. I'm talking about beating consensus expectations for 33 consecutive quarters, if you sort of exclude that initial COVID blip.
33 consecutive beats, that's nearly 8 years of being basically infallible in the eyes of the street. That kind of consistency, it just creates immense trust.
And then they stumbled. They reported $741 million in revenue, failing to meet their own guidance of $756 million and what analysts were expecting, which was around $760 million.
And the reaction?
Instantaneous and just savage. The stock plummeted 33% the very next day. It ended up accumulating a 40% total loss in the following month.
I remember the confusion. When a streak like that breaks, the explanation for why it broke becomes everything. So what was the reasoning from CEO Jeff Green?
Well, he attributed the deficit to what he called a series of small execution errors and overly complex internal reporting.
Wait, execution errors. For a multi-billion-dollar tech company that's been held up as the gold standard of management, that phrase must have set off every alarm bell for institutional investors.
Oh, it did. It signaled a breakdown in internal controls and, more critically, a real deterioration of management's visibility. I mean, if the CEO of TTD can't accurately forecast revenue within a $15 million range,
then the whole perfect management story falls apart.
It's compromised. They immediately started restructuring, but the damage was done. That narrative was permanently fractured. It was replaced by a permanent, what we call a discount for execution risk.
And just as the market was digesting that loss of trust, the inevitable happened. The secular growth slowdown. We always talk about the law of large numbers.
And it arrived. TTD's revenue base is huge now, over $2.4 billion annually. The hyper-growth phase is it's over. We're now seeing growth structurally oscillating between, say, 15 and 25%.
Which is a huge drop from the historical 30 to 40% pace.
A dramatic slowdown. I mean, their Q3 2025 growth came in at 18% year over year. Now, look, 18% is a very healthy number for a mature business, but it absolutely cannot support the 100x multiples they used to trade at.
So the premium vanished because the growth engine just had to slow down.
Necessarily.
Okay, let's pivot to the second challenge, which I think is maybe the most critical for anyone looking at this stock long-term, the quality of the earnings.
This is where we see the most, I'd say, alarming divergence.
Mm-hmm.
We're talking about the huge gap between the adjusted non-GAAP metrics that management loves to talk about
Right, the headline numbers.
and the actual accounting reality reported under GAAP.
And the driver of that massive gap is stock-based compensation, or SBC. We hear this term all the time, but can you put TTD's SBC into context? What is the sheer scale of the equity they're handing out?
The scale is, I mean, it's truly staggering. For the 12 months ending September 2025, TTD's total SBC expense was $1.259 billion.
Wow.
Let that number sink in. Their Q3 2025 revenue was only $739 million. This compensation expense is just consuming an extraordinary portion of their top line. It's revenue that's immediately being routed into employee pockets through stock.
So if I just look at a headline earnings release, I see them highlighting adjusted EBITDA. For Q3 2025, they posted $317 million, which is a 43% margin? That sounds amazing.
It sounds like a tremendously profitable software company,
Yeah.
but it's an illusion of profitability.
What's the headline missing?
It's missing the fact that the $317 million figure is calculated before counting stock-based comp as an expense. When you look at the actual GAAP net income for that same period, the number that reflects the true cost of running the business, it drops all the way down to just $116 million.
So that difference, nearly $200 million in one quarter, is almost all SBC.
Almost entirely.
This is so crucial for the listener. Management often frames SBC as a non-cash expense, as if it doesn't matter. But it does matter to shareholders, right? It's like a hidden tax on my ownership.
That's a great analogy. It's a hidden tax, or maybe even better, it's a financial treadmill. When TTD issues new shares to pay employees, your existing ownership stake gets diluted. Your piece of the pie shrinks.
And they try to fight this with buybacks, I assume.
Exactly. They spend hundreds of millions on share repurchases, like their $1 billion authorization. But they're taking cash they generate and spending it not on R&D or expansion.
But just to buy back the shares they just issued to employees.
You got it. They're converting that non-cash cost into a very real deferred cash cost just to sterilize the share count. So cash that should be boosting GAAP profits or returning to shareholders is just being used to stand still. It completely erodes the quality of those headline numbers.
And on top of that financial friction, you have the signal from insider sales. I mean, execs sell for lots of reasons, but the optics when the CEO sells near the highs are just terrible.
You're right, and people will argue it's a standard 10b5-1 plan for diversification. But the market looks at the timing and the scale. CEO Jeff Green sold over $45 million worth of stock in October 2024 at prices between $111 and $113.
With more selling in 2025.
Continued substantial selling. So regardless of the legal setup, when the person who knows the company best cashes out that much capital near the peak, it sends a signal.
The signal is that even management thought the stock was fully priced.
And that perception just accelerates the loss of that premium.
Okay, before we move on to the massive competitive and product risks TTD is now facing, a quick word for you. If you are enjoying this deep dive, we invite you to subscribe, like, and comment below on what topics you'd like us to cover next. In the description of this episode, you'll find two important links. One to our sponsor, Broker360, and another to PayPal if you wish to support this project. Your contribution helps us continue making content like this. We're only asking for the cost of a coffee. Thank you for your support, and now back to the analysis of TTD's structural challenges.
All right, let's pick up on product execution. TTD spent a lot of time and a lot of money deploying its new AI-driven platform, Kokai.
Which was designed to modernize their whole system, right?
Exactly. But the deployment has been met with, well, friction. It was much slower than they anticipated.
And what's holding Kokai back? Is it that clients just aren't buying the AI story?
It's not the story, it's the interface. Field reports and analysts like Morningstar highlighted that the new user interface was seen as clunky and confusing.
So that creates a real operational bottleneck.
It's a serious one. If you're media traders who are used to the older, Solomar version, find the new platform hard to navigate, they just slow down their adoption. And that means TTD takes longer to upsell them on those new, valuable AI features.
A classic enterprise software problem, the trade-off between power and usability. But they also stirred things up with their OpenPath initiative. What was that about?
OpenPath was an ambitious move to connect publishers directly to TTD, basically bypassing the middleman, the SSPs. The goal was more efficiency, lower costs.
But in doing that, who did they end up angering?
They created significant channel conflict. The big media agencies, who are TTD's core clients, rely on that existing ecosystem for transparency. Reports showed several large U.S. agencies actually paused or withdrew spending because of concerns about a lack of visibility into pricing.
Wow. So you risk your relationship with your most critical partners.
It's a dangerous move. Agency relationships are the lifeblood of AdTech.
Okay, so let's move to the thorniest problem of all. The competitive siege from the walled gardens. I mean, TTD's whole thesis is built on the open internet winning.
And the open internet is under attack. The most formidable force here is Amazon DSP. This is what we'd call an asymmetric threat because Amazon has an insurmountable data advantage.
Okay, break that down for me. We hear deterministic versus probabilistic data all the time. What does that actually mean here?
Sure, Amazon has deterministic purchase data. When you buy something on Amazon, they know exactly who you are, what you bought, and where you live. This lets Amazon DSP provide sales attribution, your return on ad spend, with near-perfect precision.
And TTD, on the other hand?
TTD relies on probabilistic identity solutions, like Unified ID 2.0. Now, UID2 is brilliant technology, but it's still fundamentally an educated guess about your identity in the wild compared to Amazon's certainty.
And advertisers will always go for certainty.
They'll always prefer the platform that offers guaranteed superior attribution. Right now, that's Amazon.
And Amazon is using its best inventory to lock advertisers in, correct?
Absolutely. That's part two of the threat. They've integrated exclusive, high-value content, Prime Video, Twitch, even partnerships like Disney Plus directly into their DSP. So to reach the most valuable TV audiences, big advertisers are being forced to use Amazon's platform.
Which leaves TTD to fight for what's left over.
It marginalizes them to compete for less strategic inventory on the open exchanges.
Let's talk about Google's privacy sandbox. TTD's whole strategy was banking on the death of the cookie, forcing everyone to adopt UID2. Why is Google dragging its feet actually hurt TTD?
It's a paradox of inertia. Because Google is persisting with this complex, sort of degraded cookie environment alongside the sandbox, it reduces the immediate urgency for the industry to switch. Advertisers are basically saying, well, the cookieless apocalypse isn't here yet, so why should I invest heavily in migrating now?
So the lack of a clean break gives Google more control.
Precisely. Google retains control over the auction process inside Chrome, which could potentially marginalize any third-party tech like UID2, no matter how good it is.
And the final piece is the fragmentation of connected TV, which is supposed to be the big growth engine.
Right. The CTV market is maturing, and the big players, Netflix, Disney, NBC, are building their own walled gardens. Disney has DRX. As more of that premium video inventory gets locked into these proprietary systems, TTD gets relegated to monetizing the less valuable long-tail inventory.
So we've got the loss of trust, the SBC dilution, a clunky product rollout, and this competitive siege. Let's bring it back to valuation. Even after this massive correction, TTD is still one of the most expensive stocks in ad tech.
It is. And this is the premium of risk that investors are still paying. Toward the end of 2025, TTD's valuation is carrying a forward PE of about 55 times.
And if we compare that to, say, a peer like Magnite.
Magnite trades at a PE of around 12.8. TTD is demanding a premium that's more than 4 times higher. This valuation requires a perfect comeback story, which is, well, it's highly risky given all the headwinds we've just discussed.
So the ultimate risk is that the market starts valuing PTD like a pure software platform and starts valuing it like a media company.
That's the significant downside risk right there. The analyst's verdict, based on all these structural issues, is really one of precaution hold. The stock is just too highly valued. It needs to grow into its valuation over several years, which likely means flat or underperforming returns for a while.
Okay, let's synthesize this. Here is the final provocative thought for you, the investor, to really think about. The core challenge for TTD is existential. Can they successfully re-accelerate Kokai adoption and stabilize their gap margins by getting that massive SBC under control, all while battling a fully weaponized Amazon DSP that holds a fundamental data advantage?
That is an incredibly difficult tightrope to walk to justify a 55x multiple. It's a critical crossroads, and the market is going to be watching very, very closely.
And with that, we reach the end of today's deep dive. We hope you enjoyed it, learned something new, and that you'll join us next time.
Thank you very much for listening, and we'll meet again very soon.
Remember that in the description you can find PayPal if you want to help us out. Thank you once more for your support.